Picture this. You've finally decided to take investing seriously. Maybe you got a bonus. Maybe your employer just enrolled you in a 401k and told you to pick your funds. Maybe you just opened your first brokerage account after years of meaning to. You log in, feeling motivated, ready to start building wealth. And then you see it. A drop-down list of 40 different fund names: VFIAX, VTSAX, SPYQQQ, some target date thing with a year in the name, some fund with growth and income in the title, right next to another one that says balanced aggressive growth. You stare at the screen for about 90 seconds, feel a wave of quiet panic, and close the app. You tell yourself you'll figure it out later. Later becomes next month. Next month becomes next year. Meanwhile, your money sits in cash, earning almost nothing, while the market moves on without you. If that sounds familiar, I want you to know something important right up front. This isn't because you're bad with money or too dumb to understand finance. It's because the entire fund industry has a financial incentive to make something genuinely simple look complicated, because complexity is what justifies fees, and confusion is what keeps you paying an advisor or a fund manager to handle it for you. The actual concept underneath all that jargon is something a 12-year-old could understand in about 2 minutes. Today, I'm going to prove that to you. My name is Bobby, and I spend way too much time thinking about the invisible mechanics of wealth, including the mechanics of why simple things get made to look complicated. If you've ever frozen staring at a list of fund names and felt embarrassed that you didn't already know what any of it meant, make sure to hit that subscribe button and give this video a thumbs up if this helps you out, because today we're demystifying investment funds, and by the end of this video, you're going to understand this better than most people who've been investing for years. Let's start with the concept underneath everything, because once this clicks, the rest of this video is just filling in details. A fund is a basket. That's it. That's the whole idea. Imagine you want to invest in the stock market, but instead of buying stock in one single company, which is risky because that one company could have a bad year, you want to spread your money across hundreds or even thousands of companies at once. Buying each of those companies individually would take forever and cost a fortune in trading fees. So instead, a fund manager or a fund company buys all of those companies on behalf of thousands of investors, bundles them together into one basket, and sells you a slice of that basket. You buy one share of the fund and you instantly own a tiny piece of everything inside it. That's it. That's the entire concept. Everything else you're about to learn is just variations on this one basic idea. Now let's talk about the different flavors of this basket, because this is where most of the confusing jargon lives, and it's actually much simpler than it sounds. First, mutual funds versus ETFs. This distinction confuses almost everyone, and honestly, for most beginners, it barely matters. The core idea, the basket of investments, is identical. The difference is mechanical. Mutual funds are priced once a day after the market closes, and you buy and sell them directly through the fund company. ETFs, which stands for exchange-traded funds, trade throughout the day on a stock exchange, just like a regular stock, and you buy and sell them through a regular brokerage account. For most everyday investors, ETFs have become the more popular choice because they're often slightly cheaper, more flexible, and easier to buy through any standard investing app. But conceptually, a mutual fund and an ETF holding the same basket of stocks are doing the exact same job. Second, index funds versus actively managed funds. This is the distinction that actually matters, far more than mutual fund versus ETF. An index fund is a basket that simply tries to copy an existing market index, like the S&P 500, which is just a list of 500 large American companies. The fund doesn't try to pick winners. It just owns all 500 companies in roughly the same proportion as the index itself. An actively managed fund, on the other hand, has a human fund manager or a team of them actively picking and choosing which companies to include, trying to beat the market by selecting the best stocks and avoiding the bad ones. This sounds appealing, right? Who wouldn't want a smart professional picking winners for you? Here's where the story gets uncomfortable for the entire actively managed fund industry. According to data from S&P Dow Jones Indices, which tracks this exact comparison every single year, roughly 85 to 90% of actively managed funds fail to beat their benchmark index over a 15-year period. Not most years, not sometimes. The overwhelming majority over the long run, essentially every time this data gets measured. Let that sink in. The people whose entire job is picking winning stocks, with access to research teams, data terminals, and decades of experience, still can't beat a fund that simply owns everything and does nothing. and they charge you significantly more for the privilege of underperforming. This brings us to the single most important number in this entire video, more important than any fund's name, ticker symbol, or past performance chart: the expense ratio. This is the annual fee, expressed as a percentage that a fund charges you just for holding it. An index fund might charge something like 0.03 to 0.10% per year. An actively managed fund often charges 0.5 to 1.5% per year, sometimes more. That might sound like a rounding error, but we've talked about this exact mechanic on this channel before. Fees compound in reverse, the same way gains compound forward. On a $100,000 portfolio held for 30 years, the difference between a 0.05% fee and a 1% fee can easily total well over $150,000 in lost final value. You're not paying for better performance. In the overwhelming majority of cases, you're paying more for worse performance, and the expense ratio is the receipt. Now, you might be thinking, okay, Bobby, but surely I need to research and pick the best specific fund, right? There must be some skill involved in choosing correctly. And this is actually the most liberating part of this entire topic. For the vast majority of people building long-term wealth, the best fund isn't some hidden secret only experts know. It's simply the lowest cost, broadly diversified index fund available to you, held consistently for a long time. You don't need to predict which industry will boom next year. You don't need to time the market. You don't need to identify the next great company before anyone else does. You need to own a low-cost basket of the entire market and leave it alone. The complexity the industry sells you isn't buying you better outcomes. In most cases, it's buying you worse ones, dressed up to look sophisticated. Let's make this concrete with a real comparison. Imagine two people, both starting with $10,000 and both adding $500 a month for 30 years. Person 1 builds a sophisticated portfolio, 6 different actively managed funds recommended by different articles they read, averaging a 1.1% expense ratio with a slightly lower average return due to the well-documented struggle actively managed funds have beating the market after fees. Person 2 puts everything into one single low-cost total market index fund, charging 0.04% and never touches it again except to keep contributing. Over 30 years, assuming realistic historical average returns adjusted for these fee differences, Person 2's portfolio can realistically end up hundreds of thousands of dollars larger than Person 1's, despite Person 2 doing dramatically less research, making dramatically fewer decisions, and spending 0 hours picking individual funds. The simple choice isn't the compromise. In this case, it's actually the better one. So how do you actually apply this? Here's a genuinely simple 3-step framework for evaluating any fund you're looking at, whether it's in a 401k dropdown or a brokerage app. Step 1. Check if it's an index fund or an actively managed fund. You can usually tell from the name. Index funds typically have index, the name of a specific market index like S&P 500, or total market somewhere in the title. If it's not clearly tracking an index, it's probably actively managed. Step 2. Check the expense ratio. This is listed on every fund's summary page, usually as a small percentage. As a rough guideline, anything under 0.20% is generally considered low cost and reasonable for most long-term investors. Anything above 1% should make you pause and ask what exactly you're paying extra for. Step 3. Check what it's actually invested in. A total market or S&P 500 index fund gives you broad, diversified exposure to hundreds or thousands of companies. A narrower fund focused on one specific sector or country carries more concentrated risk, which isn't necessarily bad, but it's a different decision than most beginners actually intend to make, and it's worth knowing the difference before you commit your money. That's genuinely it. That's the entire framework: basket, index versus active, expense ratio, what's actually inside it. 4 things. You now know more about how to evaluate a fund than most people who've had a brokerage account for a decade. Here's the reframe I want to leave you with. The finance industry has a vested interest in making this feel complicated because complexity justifies fees and confusion keeps you paying someone else to make decisions you're perfectly capable of making yourself. But the underlying mechanics of investment funds aren't actually sophisticated. They're a basket of investments sold at different costs, with different levels of unnecessary complexity layered on top. The people who build serious long-term wealth through investing aren't the ones with the most complicated portfolios or the flashiest fund picks. They're the ones who understood this basic concept early, chose something simple and low cost, and had the patience to leave it alone and let it compound for decades. If this video made investing feel a little less intimidating and a little more like something you can actually do yourself, make sure to smash that like button and subscribe for more content that challenges how you think about money. And if you know someone who's been avoiding investing because it feels too complicated, send them this video because the truth is, it was never as complicated as it looked.